When cryptocurrencies emerged just over a decade ago, the talk was of a decentralized utopia, a way of moving money around that avoided the usual middlemen. Today, things are moving in a very different direction.
Around the world, central banks are racing to create their own versions of digital money. And nowhere is this happening faster than in China.
This is going to happen, and those countries that trial it and test it earlier will probably be in an advantageous position.
One very obvious negative element or motivation that you can think of is the application of surveillance and monitoring.
I think this is a global race and we cannot afford to not be part of this effort.
In this video, we'll look at how the rise of cryptocurrencies like Bitcoin triggered a radical rethink about what money actually is and who controls it. How central bank digital currencies, or CBDCs, could disrupt existing power dynamics in the financial system, and what all of this could mean for you, the consumer.
But first, some background. You've heard of Bitcoin, Ether, Dogecoin and the like. These are cryptocurrencies, designed to allow you to pay for stuff without any government or bank being involved. They're based on blockchain technology, a kind of digital ledger that records transactions in a chain. It's hard to tamper with because doing so leaves a trace elsewhere, potentially for everyone to see. That transparency is one of its most promising features. In the past year, backing from high-profile figures like Elon Musk, as well as established payment companies like Visa and MasterCard, have given Bitcoin in particular a massive boost, sending its value shooting up, but often swiftly back down again. The rapid rise of cryptocurrencies initially left governments and regulators scrambling to respond.
There was a lot of discussion around how this Bitcoin currency would be used for money laundering or for terrorist activities, and people were worried and they couldn't understand that the infrastructure technology of blockchain was actually an amazing way to remove intermediation.
Meanwhile, the private sector was spotting an opportunity. In 2019, none other than Facebook arrived on the scene, promising to create its own version of digital money that wasn't volatile like Bitcoin.
I believe that it should be as easy to send money to someone as it is to send a photo.
The plan, a so-called stablecoin whose value would be pegged to a bunch of established currencies. The project, originally known as Libra and since renamed Diem, raised a lot of eyebrows.
Most central banks were really scared at the beginning when they heard about this project. Okay, there will be a new asset that will be adopted by 2 billion people from day one, and it will compete with our domestic money.
The idea of a big tech company becoming a major player in the financial system wasn't the only issue that governments had with cryptocurrencies. They were also worried about what widespread adoption could mean for their ability to implement monetary policy. Here's why.
Right now, central banks have the power to respond to what's going on in the economy. If things are sluggish, they can lower borrowing rates. They can even just print more money. If things are overheating, they can raise rates. They can also make rules about how much cash private banks need to hold in reserve.
But all this falls to pieces if people are no longer using the traditional currencies that central banks control.
I feel that if the role of a central bank is to keep the financial stability, I think this would happen not by ignoring what's happening out there, but actually implementing new technologies, embedding them in your system and trying to be globally competitive with innovative solutions and give more options also to the citizens.
In other words, if you can't beat them, join them. And that's exactly what's happening right now. Over the past few months, central banks have been racing to develop their own forms of digital currency.
A central bank digital currency, I think, would be a way of, to some extent, controlling the potential negative impacts of having, Facebook money or or Amazon money.
Basically, central banks are approaching us to do some pilots and tests of how we can build a CBDC, how we can design it. And so we've been working with a dozen of central banks on building such CBDC networks, which involves the central banks, but also the domestic banks or payment service providers.
And if there's one country that's responded especially decisively, it's China. It recently banned homegrown banks and payment giants like Ant Group and Tencent from handling cryptocurrencies. And in the meantime, it's been very busy creating its own version of digital money, one that it can control. Hundreds of thousands of people in China have already taken part in trials of the digital yuan, spending their government-issued coins in Chinese outlets of Starbucks and McDonald's. And next year, things are set to go a step further.
The Chinese government already has plans to have Chinese citizens abroad use the digital yuan for transactions for retailers. But imagine, I think one really interesting event that we could watch is the 2022 Beijing Olympics, because they have pretty, it's been announced, ambitions or plans for foreign visitors to use these systems, to participate in these broader pilots.
The digital yuan is programmable, meaning that it can theoretically be given an expiration date. That way, if the economy's flagging, people can be easily coerced into spending.
I think this probably plays into the Chinese government's push behind, trying to have consumption-driven growth. I do see a little bit of pushback. At least on the forums, people have talked about what does that actually mean? Does that mean I have to spend certain money? I don't have a lot of control over how I spend my money.
It also means that for the first time ever, the government will be able to track citizens' transactions in near real time. The rather confusing term being used to describe this capability: controllable anonymity.
Controllable anonymity, to my understanding, it promises a kind of horizontal anonymity. So you can think about the counterparties that are involved in a transaction can't necessarily access each other's personal information, but there is no promise or no guarantee, rather, of vertical anonymity. So any kind of user information can be readily available for the government. So I think that obviously has surveillance implications, even though that's not necessarily in the official guidance documents.
China's full steam ahead approach comes at an already tense time for geopolitical ties. Trade conflicts, questions over Beijing's handling of the pandemic, not to mention reports of widespread suppression of minorities in Xinjiang, are all putting a strain on international relationships.
Which brings us to another crucial aspect of this story: power within the financial system.
Right now, economic sanctions are one of the main ways of dealing with political and trade conflicts. Think American sanctions on North Korea and Iran, or EU sanctions on Russia following the annexation of Crimea. Sanctions are enforced by stopping financial institutions from handling transactions linked to certain individuals, assets, or regimes.
Some commentators have suggested that China's digital yuan could enable the country to avoid Western sanctions by lessening its dependence on the US dollar. Others, though, say those concerns are overblown.
That's a headline. It's an attention grabber. I think it's in the very, very long run, perhaps. But my thinking is whether China piloting its own national digital currency could eventually unseat the role of the USD. For this to be true, I think there are a few conditions that have to be present. So first of all, I think the Chinese RMB actually has to be a preferred currency for transaction, which currently is not, at least compared to the USD.
It's a fair point. While there has been a lot of discussion about the dollar's waning dominance, it does still reign supreme. In 2020, nearly 60% of all global foreign exchange reserves were held in US dollars. China's yuan, in contrast, made up just over 2%.
So as China charges ahead, what is the rest of the world up to? Well, a recent survey showed that 80% of the world's central banks are exploring their own versions of digital currency.
Major Western powers like the United States and the United Kingdom are in the research phase. As for the Eurozone, the European Central Bank recently announced a multi-year project to create a digital euro. Along with China, South Korea and Thailand are already testing out versions of digital money. Canada, Russia, Venezuela, Brazil and South Africa are all working on development. Fun fact, the only country to have already introduced a CBDC is the Bahamas.
Largest central banks are even more cautious than the others, but they are forming working group, task force, assessing the opportunities, what are the benefits for the individuals, what are the risks for the banks, etc., etc.
And in the case of the European Central Bank in particular, there's nothing like a bit of competition to speed things up.
So it depends which is the country that uses a digital currency. And you understand also that if this would be the case with China, we have every reason to invest more into having very fast digital euro. Because a Chinese fund would be used the biggest platforms like Tencent, Alibaba, MasterCard.
So the pace may differ from one country to the next, but when it comes to the question of rolling out central bank digital currencies, it seems to be less of a question of if, but when.
Control over monetary policy and geopolitical wrangling are just some reasons central banks have for developing digital currencies. But from a consumer's perspective, is there an actual point to them?
The point of central bank digital currencies is in some ways to simplify and enhance the efficiency of the payment system that we have today.
If you've ever tried to send money abroad, you'll know that it can sometimes take an age to clear transactions. Proponents of CBDCs say that a new internationally compatible system would vastly speed things up. This is an especially big deal for the millions of families who rely on money sent home from relatives working abroad. Another group that could benefit are the 1.7 billion people in the world who currently don't have a bank account.
And private commercial banks don't have very much incentive actually to give lower income people bank accounts, particularly if they don't have a secure income, partially because they don't want the risk of that person not being able to pay back their debts. Now, if you had a central bank digital currency, again, you could put into place legislation and rules to ensure that everyone would have a bank account. So that would be, from a financial inclusion perspective, I think it could be a step forward.
Legislation, rules. If you think all this sounds like we've come full circle, you'd be right. After all, the technology that underpins cryptocurrencies like Bitcoin is designed to be decentralized and anonymous. So where does a CBDC fit into that narrative?
We use basically the blockchain infrastructure to monitor the supply, to know who owns what, and to record transactions. But everything related to identity would be kept in external system managed by the banks, the central banks, or the payment service providers.
This is exactly the difference that you have for Bitcoin. It will be like using your credit card for a consumer, and for a user, it will ensure the anonymity, but this doesn't mean that we cannot keep the trace of the transactions.
But that's the very aspect that some people are uncomfortable with, fearing that these traces could give governments too much power and information about citizens' spending, similar to the way big tech companies already mine users' data today.
So the incentives for a big tech company to issue a monetary token are very high from a sort of gathering data, and people might even prefer a central bank digital currency if there was sort of a design mechanism in there that prevented the government getting hold of personalized data on what you were spending your money on.
At the end of the day, a lot of this comes down to trust. Who do you want to control and safeguard your money? A central bank A social media company like Facebook, or maybe nobody at all? The answer to that question could well determine our future relationship to money. If you have any thoughts on this, let us know in the comments below. And if you'd like to watch any of our previous videos, you can check them out on our playlist right here.